Okay, well, we got everybody here. Let's call the meeting to order. And
Do we need to record?
it's all set. It's
All set,
recording.
yeah.
That started it up. So first thing, I think we've got a guest here. Let's talk with our guest. Um, our bylaws say that every, I don't know, every so often we're supposed to um consider whether we want to keep having a money manager, which John would say we definitely do. I would say we definitely do. I think we all would say we definitely do. And this is our way of considering it, is just to have a talk with you and get a chance to ask questions.
Yeah,
Can I just,
Want to go around and introduce ourselves?
And yes, and so we should introduce ourselves.
I'd like to add, change of meeting date to the, continuing from the last meeting, just so that we include that.
Yeah.
Right? So just add that to the agenda, that's the only thing.
Okay, change of meeting date from the September 1st date that we
Yeah.
have been considering.
No, in other words, that we're meeting on Tuesdays from now on. That's
Yes.
all. Just we haven't voted on
You didn't?
it. Am I getting it?
All right.
Do we need to,
We're gonna need one.
or we're just saying,
we just agreed to schedule.
Yeah, we just gotta.
Did it.
that's what I thought we had.
I just wanted to put it on the agenda.
Are these all like, they're all the same, so. Keep your.
a little self-conscious about how much paper I just brought, but the quarterly statements are kind of thick. So,
All right, so let's just quick introduce ourselves and then you can
sure.
sort of give us an orientation and we'll ask any questions we have.
So I'm Felicity Ratte. I'm a member of the board.
Bob Ferranti, Vice President of the Board.
And I'm Margaret Atkinson and I'm the board chair.
John Orgazalek, I used to be on the board and I'm back on it. Just to help them out, I guess.
Mr. Biddy.
Jenny Rowe, treasurer of the board.
Nancy Belleville, interim library director and youth services librarian, so that's for us.
Okay,
I'm Prentice Smith. I run Prentice Smith and Company and happy to be here. So I will speak a little bit to this year and market conditions, but also happy to take questions that are outside of that or things I don't cover in my presentation. So I'm bringing the end of June statement. This just got sent out in the mail this morning, I was told by this. So I want to make sure you get a copy here for this conversation. And I also brought a performance report that shows data in this, but also then shows data through July, as July is now already closed. And July was kind of a wild month. Yeah, it was a good one for us, but there was a lot of gyration in the market, and everything that we wrote about in our strategy update, which we sent out to clients, frankly feels stale 2 weeks later. I authored it and then it felt a little prescient and now it feels kind of stale. And anyways, I'll get into all that. But that's the reason why we brought this performance report that speaks to the end of June, but now also the end of July, because a fair amount has changed. So this year, really in spite of all the headlines, all the geopolitics and war and disruption and rising oil prices, all the big macro events that typically move markets. This year, it really has just been about one thing, which is AI. Almost with few exceptions, every day feels viewed through the prism of AI by investors. And it became really quite insane through the end of June, where the market just started to split in half, basically, between stocks that were perceived to be AI beneficiaries, which is probably a much wider set of companies than most people would think of. It included companies like Caterpillar, because their machinery is used to prepare sites for data centers, and their generators are used to then power those data centers. So from computer manufacturers, semiconductor manufacturers, all the way down to something like Caterpillar or utilities. There was one side of the market that was on, put in the winning category. And then another part of the market that was put into the losing category. And those were traditional software stocks, but there were also companies, really anything that touched on intellectual property or generalized intelligence. All of that was thought to be completely disrupted by AI. And so on the other side of the equation, you had companies like Microsoft or Moody's, the bond rating company, consulting firms, and anything that was a asset light kind of intelligence heavy business was in fact put into the losing side of the category. And the level of split was, it's hard to overstate how extreme it became. The market as a whole wasn't quite where we were in 2000 during the tech bubble, but that kind of wrenching of the market in half, one side being the winners of this new economy, the new AI economy, and the losers, which were the old economy stocks, was very much an echo of 2000 and the dot-com bubble. And the idea that the entire economy would be split in half between the new economy stocks that would benefit from the internet and everything else that was brick and mortar that would lose out. And it frankly stopped making a lot of sense. And it wasn't a particularly easy market to navigate because every day movements in stocks really were just dictated by that binary decision that that the market had arrived at. And so our portfolio that we've constructed is not particularly heavy in AI infrastructure stocks. There are some companies that have had a benefit. John pointed out EMCOR. They do electrical engineering. And so we bought that in 2022. They had an upswing in business from the Infrastructure Act during the Biden administration, grid work, and that was good. But now they've fallen into all kinds of AI related business as they connect data centers to grids and whatever one's feeling is on data centers, they've benefited. It was never really the thesis we started with. We bought it in 2022 before any launch of ChatGPT or anyone knew of AI, but it's one of those companies that has benefited. So there are a few things that have had some exposure. The amount of investment now taking place, frankly, it's spilling into all kinds of industries. Filtration comes with Atmos Filtration, which we have in the portfolio, is getting a small benefit because they make air filters. It's been a nice environmental stock for us to own. The filtration is important. Most of what they sell to is trucks and heavier equipment like that, but they also have their filters in generators, and some of that is going into the data center business. Again, none of this is an intentional focus on AI, but it just speaks to how kind of widespread the spending is, that it's including a lot of different companies to a small degree. But with that said, we did not assemble a portfolio that was intended to be AI focused in any way. And the reality is, through June, the stock market, when you think about all these different market caps and all these different respective sizes of companies, the stock market as a whole had become kind of an AI play. When you add up the biggest companies in the world, the ones that are worth $1 trillion or more, they are all AI connected. And at the very end of this period of time, you had the IPO of SpaceX, which is worth $2 trillion or was before some recent declines. That is in fact an AI play, because the reason for excitement is that at least the idea presented by Elon Musk is he's going to send data centers up into outer space, and that will fix our terrestrial problems. But it just speaks to how much of the market is now seen through the lens of AI, how much is um, lifted higher by this theme. And we don't, the coda to this is at least through July that has started to fall apart, which has been good for us, frankly. The portfolios continued to push ahead, and actually investment gains have accelerated in July as the market has stagnated. And we've fully caught up to the indices as the whole AI complex has started to decline in value. Because there's so much else out there. I mean, you have a market where at the top there are 10 companies or so worth $1 trillion or more. They now drive half the index on a daily basis. And there are hundreds and hundreds of other companies below them that we find interesting, that we find appealing, that had just been kind of discarded or left to the wayside as people hunted around for AI stocks. And it all came to a head last week with this implosion of a hedge fund, this star 24-year-old manager who had been probably like the poster child of the AI investment bubble. And I say this with like a little bit of Schadenfreude, but it was kind of, he was the rock star investor of our moment. His fund had gone from 10 billion to 45 billion in just a few months. And he was using leverage and had I think quintupled at 500% return, and it all came crashing down last week as this trade started to unwind. And so today, frankly, just a month on, feels like a very different environment than had we met on June 30th. Obviously, I hope maybe not obviously, but it is something I hope continues, because we have a portfolio that we constructed piece by piece, companies with discrete scenarios in mind, trying to find just high quality companies that are exposed to, we're looking for secular trends and secular tailwinds, but we want that to be a diverse set of things. We're not building a portfolio that is focused on one idea. And for an investment manager like ourselves at this point, to build a portfolio that would in practice day-to-day match the market would mean, practically speaking, we put over half of one's assets into AI stocks, which doesn't feel responsible, but that's the way the market's constructed now. If one owns an S&P 500 index, about half your money is just in AI stocks.
Sure.
And that's not what we do. I think that there's inherent risk to that. But it does mean that during those moments, and hopefully they're fewer and far between, where the market just gets gripped by AI fever, there are days where it feels like we are in a different world. Where our stocks, from small cap companies that no one's ever heard of to large companies that are household names like Progressive Insurance or New York Times. I mean, it feels like they are just an entirely different thing, an entirely different, frankly, a forgotten asset class. But it's been a bizarre year, and I have no doubt that it will continue to be kind of bizarre, because I think that however this whatever course this runs, I doubt it will be quiet. I mean, there is hot money in the space. There's hot money leaving the space. It is incredibly, in some sense, controversial. You can't generate the kind of enthusiasm that's manifested around AI without people offering really pretty wild scenarios of the future. And it's what we wrote about in the strategy update. Stock markets that get gripped by big transformative ideas can do big crazy things for a period of time. And some of those things will come to pass, just as they did in 2000. I mean, the internet revolution did happen. I mean, the world is changed by the internet. There were still insane valuations in stocks that disappeared, and companies that took 25 years to recover from the prices they were at then. So it's not to say that I have cold water to throw on every prognostication around AI, but the the valuations that we reached about a month ago were pretty insane. And so I for one hope that there is an ongoing reckoning or just rationalization, within the market. I think we will do, no guarantees of future results ever, but I think that the portfolio we've assembled would perform relatively well in a market that starts to, at least just cast a wider net beyond the singular theme of AI into other facets of the economy. The economy isn't in great shape today. I mean, inflation is not going away, and the price of oil is bouncy based on kind of the latest messaging and state of peace or otherwise in the Middle East. But we are far from the doomsday forecast back in March of oil at $200. It's at 80 today. Some manufacturing data is looking a little bit better. So there's reasons to think that the economy at least is healthy enough to allow these companies to hopefully succeed, excel on their own, not run into a recession or worse. And if that holds, I think that what we've put together here in terms of the stock investments should fare hopefully pretty well. The month of July has been encouraging to see the AI trade fall apart, and our portfolio that we put together for the library and for many other clients just continue to check forward. There is also the bond side of things, which is a big component of the larger endowment fund, a slightly smaller component of the building fund. Bonds have had a hard time this year just because inflation is not going away. It's pretty sticky, and bonds do not like inflation. Bond investors do not like inflation. There are probably pretty fairly concerns about ongoing deficits and budget deficits and debts, and I share that concern. That's why a year ago we started buying inflation-proof securities just to kind of minimize our exposure to some of the problems that might arise from a government that's carrying too much debt. But we are starting to extend out the bond portfolio, add to the bond portfolio, because yields are now between 4.25% to 5.25%, which historically is a pretty attractive level for fixed income investors, but even those investors who want to have a balanced portfolio of stocks and bonds, which is most of the accounts that we manage internally. It's that mix of stocks and bonds. Historically, that's been a good approach. Historically, with some exceptions, if stocks are challenged by economic events, bonds tend to do a little bit better. And so there's this natural balancing act that occurs, and hopefully that creates stability. And now with bonds at yields of 5%, they also just contribute meaningfully to investment returns. So we are building out the bond portfolio as we speak. The cash levels have fallen a little bit just because we added a large bond in July, which isn't reflected here. But we're day to day, we're actively shopping for bonds at the moment. Nothing too long. Should stress that, because long bonds, 20, 30 years in length, those are the ones where if something does go wrong, if we are headed towards some uglier outcome in terms of deficits and debts, you will really feel it on the 20 and 30-year bonds. Right now, the bond portfolio is about 3 to 4 years in length. It's pretty short. So that means that swings in the broad bond market become very small when they are down in bonds at 2, 3, 4 years. And when they mature, we'll just have to assess the state of the world and see if we want to continue buying treasury bonds or something else.
So you're shopping, are you shopping for corporate bonds as well as treasuries?
We do, yeah, we shop for corporate bonds, and corporate bonds make sense, in particular for accounts that don't pay taxes.
Yeah.
So the library would be a good candidate. And there are some corporate bonds. The spread between the two, between treasurers and corporates, is pretty thin right now. I'd love to see that widen a bit, but I would think that we could start buying corporates if there were yields at 5.5%, 6%. But right now, there's a very thin spread. And we see that throughout the bond complex. We wouldn't buy municipals for this account, it wouldn't make sense, but municipals have basically what I'm saying is treasurers in particular are under pressure. And that may very fairly be a reflection of the current state of our budget in this country. And treasuries are kind of the manifestation or the tip of the spear in that regard. So I think that's kind of the broader macro commentary I have in mind. And you'd asked about cash. The cash at the moment, it's starting to separate as bond yields rise. But for quite a while, the yields on the money market funds, which is almost the entirety of the cash in the account, was close to the same amount that you get in bonds. So we were comfortable holding more cash because switching to bonds would just be cosmetic, kind of. The income's about the same. That's changing. And so as the yields are rising, it does motivate an investor to move out of the cash into bonds in particular that they're carrying in some cases maybe an extra 0.5% in yield. Every bit matters. But up until recently, the yield on short-term treasuries and the money market fund were close to the same. But that's changing, and we're buying bonds in response, and the cash will fall as that does. And the cash would fall if we just found more equity investments. Right now, there's probably I'd say probably 10% in the account, in the larger endowment account, that I could see going into stocks if the opportunities were evident. So that's the larger positioning, the larger macro commentary.
Do we have a long-term strategy for, it's quite likely that market is near top. So do you have a long-term strategy for what's going to happen when there's a correction to the market and buying opportunities are clear? Since we have so much cash, it might make sense to prepare.
Well, yeah, I would think of cash and frankly any short-term bonds as readily available funds to invest in the market if things were to decline. The question in my mind is, and I agree, the market in its totality is pretty expensive. By any historical measure, the market's expensive. My hope, and it could be, no guarantee that it will play out this way, but my hope is that this market that to me feels very top heavy, and it's those big names that are lifting the valuation on the market. Things like Caterpillar, which was recently a $700 billion company with a P of 50, which is a multiple normally you have for a
Software company,
like a brand new IPO,
Right,
or a company that's just getting started. And this is a manufacturer of heavy machines that's been around for 120 years. So I guess in a perfect world, we'd have a market that gets cheaper and corrects and does so from the top down. Does so because it's hard to justify the valuation on Caterpillar or Tesla or some of the semiconductor companies. And those are an interesting category to themselves because you have situations where the math isn't, at some level, the math isn't stretched on a company like NVIDIA, which makes so many of the processors to power these data centers. And for much of this year has held the title of the world's most valuable company. They are making just unbelievable amounts of money. So the stock isn't actually that expensive. And so one can take that and say, well, the market's not expensive. But I look at it and the operating margins on NVIDIA and Micron, which makes a lot of the memory chips that go into data centers, their margins right now are 85%.
Mhm.
They are sitting at a level of profitability that no company has ever um, uh, found for any considerable length of time. I mean, companies just don't maintain that profitability. Even pharmaceutical companies, which have these monopolies and are almost entirely IP, they don't have margins as high as Micron does now. And Micron, for much of its history, has ran losses. So the whole thing just feels stretched, whether it's the valuations or the level of profits.
Right.
And so my hope is that there's a world in which that all corrects. And I don't want to be naive and say that like the market could correct and we wouldn't feel anything. I mean, I think there would be selling at a certain point in time. If the market starts to fall hard enough, people sell Procter and Gamble and AT&T to raise money. You know, you end up with extreme events like margin calls and people just basically looking at the couch cushions for anything. So it's not to say that I think we could just kind of whistle past any extreme decline in the market, but there are periods where certain sectors of the market get really overbought. If you don't own those, then on the way down, hopefully it doesn't feel quite as punishing. And there is quite a bit in short-term bonds and cash that could move over into stocks if the market as a whole got cheap and attractive. We were bought the last time really we were more aggressively buying, multiple buys within the span of a couple of weeks was back in April of last year during the whatever you want to call that. But during the introduction and pullback of tariffs. The market crashed. We started to buy stocks and to some decent effect. So who knows what the next thing will be that could cause an event like that. If you wait long enough, something will happen. But right now, what seems to be moving markets most days is simply the on-off relationship with the AI trade. Whether or not someone's having to, last week, liquidate their AI holdings to meet investor funds or demands. But it's volatile. It's pretty bouncy. Fortunately, we are invested in a basket of stocks that don't feel as bouncy or volatile, but there's a whole category of stocks that are often up and down 5% every day, just because of just how violently money is moving in and out of the AI space.
What do you consider the extremes for our account that you would want to go to, low and high stock percentage? We must have given you some instruction about that at some point.
Yeah, for the largest account, I'm most comfortable managing between say 40 and 60% equity exposure.
Yeah.
Leaving it a true blend of stocks and bonds. There's that to me is a little bit the baseline exposure level for an institutional account or an endowment. You could certainly argue for a more permanently aggressive level of investment. We have a few endowment relationships I think are more aggressive than that. But the problem is where you have an endowment fund that could at certain times be relied upon for capital uses or any other operating uses. You want to balance just the likely growth that comes from having a more aggressively positioned stock account to the volatility that could precipitate. And you don't want to be in a position as a money manager for an institution that needs money on a given day or needs to over a given year, and it's just not a great time to hold funds. So the impression I've always gotten is that this is an account that's somewhere in between, and so I think 40 to 60 is a good range. It doesn't present an extreme on either end. I think it would be probably a mistake even during times where the market feels expensive to really move out of the market, because I found it's often hard to find your way back in once you do that. So moving below 40% would have to be a pretty unusual moment in time. And moving above 60, maybe 65% probably would be, well, it'd certainly be aggressive relative to how it's been managed in the past.
Yeah.
And so, yeah, something along those lines, I think, makes sense to me. And I think it accurately reflects the conversations we've had over the years.
Okay.
Anything else?
So yeah, my question about strategy was specifically about, have we started to put aside a notion of what basket we would buy? Rather than just, yes, there'll probably be a correction, and yes, we should figure that we want to increase our equity exposure at that time. Have we started to identify?
No, I haven't, honestly. I haven't, because we're always looking for stocks that are, that in some way feel underappreciated by the market. And either that it could just simply be that they are mathematically really cheap, or they're growth companies and we don't think that the market has fully grasped the potential of the growth. So it's I don't want to manifest that we are deeply contrarian or we're looking for the most unpopular stocks in the world. But we're trying to find companies that have really strong businesses, something unique, and at the same time, the market hasn't fully appreciated those attributes. And that sounds very obvious and simple, but it's hard to do. So I would be looking for businesses of that nature, and where the market has feels like has missed something. As of even just a month ago, that was an easier task, because again, there was this whole category of stock that felt either ignored or outright unliked by investors because it simply didn't have an AI angle. And so I think the last position we bought was Stryker, which makes orthopedic, hips and knees, and it's been a tremendous performer for 30 years. So it's been a great company from just an operational standpoint, a great stock to match, but it had fallen out of favor, and it was the cheapest it's been in probably 15 years, with a couple like extreme. I think it was probably cheaper during March of 2020, but for the most part, it was cheap, and in our mind. And one thing it didn't have going for it was any kind of AI story. There was nothing to speak to there. And we're in a moment where, from a political standpoint, it's not all that easy. There was concern caused by some of the healthcare providers, some larger ones, around weakness just related to Medicare cuts and changes to ACA or Obamacare. So there are political pressures in this current moment, but I'm optimistic and thinking that will change. There will be change, and when you buy a stock, or when we buy a stock, we're looking 3-4 years and more down the road, and I think there could be a different set of political and also business circumstances for a company like Stryker, for whom at the moment business isn't even all that bad, but there is some concern. It's not the easiest time to be in the healthcare space as a public company, and so hopefully it will be, when we look back on it, that we bought Stryker at a discount. So that's what I was looking for as of a month ago. The more the market recalibrates, the more the market kind of tips the other way, away from the singular AI theme into everything else, the better the portfolio will do, and the harder it becomes for me to find new things that look and feel like Stryker. Because now Stryker's up, it's not a tremendous, but it's up 5-10% from where we bought it. More over a month and a half ago. So it's just a little bit more expensive now today than it was when we bought it. And everything is that way as the market repositions and turns over a bit. So I don't know. I like it would, we continue to hunt for more things like that. But they're a little harder to find today than they were even just a couple months ago. And there may come a point in time where the turnover gets so tremendous that we go the other way with it. And that there are these companies that I would probably gravitate towards the companies that are only incidentally connected, kind of got dragged along for the ride and now are getting thrown out as it relates to the AI trade. John, you mentioned MCore. Up until they had a great report, that was a stock that was selling off because they had gotten attached to the AI trade, and then they were part of the sell-off. And so that was a stock that before they announced earnings had gone from 800 down to 650, which is a pretty big discount. They announced earnings. It was a tremendous quarter for them again, and that's back up above 800. But there may be things like that. Companies that kind of went along for the ride and are now in the wrong, are now part of this big sell-off, maybe unfairly. It's going to take a while though for me to feel emboldened to do that, because the ascent has been so extreme. But if one's looking for stocks that are selling off in the moment, you start there.
Yeah, so my concern is that it looks like about 25% of the portfolio's in cash. And I think the precept that's because we want to be able to write a big check never been reflected in our behavior. Like nobody's ever said, okay, we need to write a, $250,000 check to pay for something huge.
Yeah.
I have a question.
It's more like we're pulling out like a 4%, like a retiree.
Right, right.
4% a year.
Yeah.
Yeah, and so, I believe we might want to consider a more aggressive equity position, set of equity positions with light of that. So, I'd love to discuss this.
Yeah,
I'm sorry to interrupt.
No, that's all right.
the allocation, the endowment as of June was a little over 20% in cash. And like I said, we did a bond buy. So that's lower today. I mean, to match where I kind of
I'm just going with the pie chart.
yeah,
That's all our accounts together, which
Yeah.
includes, that one is all cash
Yeah.
and that one is
Each
pretty
one's
much all
all
cash.
cash. That's what I was gonna ask.
Oh, that's a good question. It looks like the building fund is all cash.
No, it's it's this one.
That's all
Number one.
cash.
That's our checking account, basically. And number 3, which is our board projects.
yeah. So just as
So that's 200.
That's 200.
So if you subtract that from the total cash of 715, no longer is it 25%.
Yeah, you said it's more like 20.
So on the next page, you got just the endowment fund, which is at 21.7 or was, but
yeah, the two accounts that we are actively managing day in, day out are the endowment and the building fund.
Oh, the building.
okay.
Everything else carries other instructions or directives with it.
Right.
Anything I talk about in terms of like generalized strategy, you're only going to see play out in the endowment and the building fund. And the building fund right now is at 14% cash, and that's also going to be a little bit lower now, reflecting the bond buy. And the endowment was 21.7 as of this report, and that's also a little bit lower. I agree with. I mean, I think anything north of 20% on the endowment is high. And I think some of that will rectify if we get the fixed income up towards, say, 40% and stocks up towards 50%. That's kind of where I would see the account in a way that reflects my just larger market view today. That still leaves a 10% cash position,
Mhm.
but that would feel to me like appropriate reserve for changing circumstances, market decline, something on that order.
Some dry powder for,
Yeah,
Well,
So it's those
we need
two-
to use some cash.
in case we need cash.
Yeah, like something happens.
so
like
you're,
a fire.
I certainly take your point, but it's those two accounts that I look at the cash levels on, and I'm trying, and those are the two that reflect our investments and our market outlook. The other accounts, which are smaller, really are an entirely different category. But if you have accounts that are entirely in cash, which a few of those are, it does move the overall pie a bit.
Yeah. Makes sense.
I have a question about social responsibility.
Mhm.
So you have that on your name.
Yes.
So how does that like guide the companies that you choose? Because some people would say anything having to do with AI, it's an environmental calamity.
Sure.
Pache Elon Musk.
Yeah.
So not socially responsible.
Right. Yeah, so what we have done within this account and the majority of our accounts is stay clear of certain sectors, just at a base level. There's the old school social responsible screen that was alcohol, tobacco, firearms. That now for us has in the last few decades has also included oil and gas and coal and fossil fuel companies, any defense companies, and the last 10 years, you can't really talk about this without also talking about the technology companies. I had a conversation with the library probably 10 years ago now, talking about Alphabet, which is a holding. I don't know if it's in this portfolio anymore, but we had Alphabet and which was Google back then, and censorship in China.
I remember
These
that.
companies
I was
are
there.
these companies are so big and they touch on so many facets of our lives that increasingly, to me, they feel like kind of the third rail of investing from like a socially responsible investment standpoint. And at the same time, to have a portfolio that has no technology in it at all has been, I mean, you're at a disadvantage, at least looking back over the last 10 years. So we've tried to, where we can, where it feels at least digestible, to buy some tech companies. We have Microsoft and Cisco, both of which, at least within their own operations, have a very, or at least did have a very clean profile from like a just renewability standpoint, and they felt like companies that were not just greenwashing their operations, but actually doing something internally. I don't know that I can say that about Microsoft anymore because it's like every other company building out massive data centers for its cloud business, Azure. So yeah, that part has gotten really tricky. But for us, what it has meant historically is staying clear of companies that are in certain industries that we just consider to be off limits. But we and hopefully clients an agreement do not find ethically appealing in any way. And then from there, we just try and balance the product and what the product is doing and hopefully delivering in some way that's helpful against the operations of the company. Every company has some kind of footprint or impact that is imperfect. So if I look at the portfolio today, there are a couple companies that to me have some connection to data centers and AI build out. We didn't buy them for that reason. And because of the businesses that they are, I hope that they can succeed as these data centers inevitably get built out because one is Xylem, which does water treatment, and hopefully their products will be used to just lessen the amount of water consumed by data centers. And the other is Atmos Filtration, whose filters go into all kinds of things, but also to some small extent, the heavy machinery, just keeping these plants going. So if you start with companies you find to be appealing in the product that they deliver, you may end up in some businesses that were unintended and you don't love necessarily, but the role they play hopefully still is a good one. But every company that's in the portfolio has gone through both a screening process to make sure it meets a baseline for us as investors. And then also if we can find it, companies that rise above just simply a baseline, it's something that's in our mind bringing a net positive to things.
Thank you.
I remember 10 years ago when I was just had become a trustee, and we asked you, could you put another filter on our account for something more library specific, just sort of hypothetically, maybe free
Yeah.
speech or something like that.
No, I remember that. And that's and that in the moment would have been tricky and probably probably affected performance pretty significantly. And today would be even harder to implement. You know, I one has to be careful with social responsible investing. You don't want to make claims you can't support, but you also don't want to. I mean, I don't want people to think that there's some kind of sacrifice or price to be paid from putting your money in investments that that align in some way with your beliefs. And I think that's been borne out by the last 20, 30 years. I don't feel any kind of sacrifice in performance, not being able to invest in Philip Morris or Boeing or companies that in periods of time have performed well as stocks. They've both had some rough patches. ExxonMobil hasn't been the best holding over the last 20 some odd years. There's been no one's had to have a trade-off. No one's had to pick between the portfolio they want to build and the performance they can get. If you take that a step further and draw a circle that excludes all of technology, that's half the market right now. And it does become, it's not, I'm not saying it's impossible, but it'd be a very challenging task, I think. And so we pick and choose our spots. You know, we're not invested in Palantir, which has all kinds of defense contracts, and operates in a way where I can't really even speak to what they're doing and what kind of surveillance they are part of. And instead, we're invested in Cisco Systems, which makes networking gear, and some of that's now going to data centers, and the stock is doing well because of it. But I won't kid myself into thinking that we've completely steered past all the thorny issues around AI and data centers in this portfolio. Just, I guess, just enough where I can sleep okay now.
Thank you. Do we have any other questions?
No, I don't have any other questions. You covered quite a bit.
Thank you.
Thank you.
Yeah.
Sure, yeah, and pretty much all of this will be coming in the mail, but I wanted to leave you with what, obviously, the statements, the strategy update, which will probably more, just because I had time to sit down and write it, but it really is a lot of what I just talked about in terms of the way the market had been seen, at least through June. Some of the, like, in some sense, it's disappointing because so much has changed since I wrote this. And the date's July 20th, but I was like coming up with the idea in early July, and now it feels a little stale. It also feels a little prescient, which is kind of nice. But I want to leave that with you just because that will be coming also. But this is advanced copy, and then this is just something separate this is unusual, but again, I just wanted to put numbers to kind of what to me has felt like an extreme rotation in July. I don't know if the numbers will look that extreme, but there's been good forward progress in July, and the market is just
Yeah.
went sideways. And so the June statement's already a month old. But I like to do that.
No, he did, and I had a nice July.
Yeah, I hope it continues. I mean, the market, yeah, we'll see. Let's see what happens.
Thank you very much.
Thank you.
Thank you.
Yeah.
Yes,
Yeah, thank you.
thank you.
I feel like this has been a point of conversation before.
Yes,
And I can't remember.
could I just get with Penny?
Yeah,
Okay.
yeah, I'll bring this back to Penny and start the conversation with her tomorrow and just let her know.
Tell her
that-
I'll be
that
in
you
touch.
might be
Yeah.
calling, and we'll try and align what we have. It will require some paperwork because these are titled accounts at Schwab.
Yep.
And so we just need, basically need signatures, I think, to get things changed, but I'm gonna let her speak to that
Okay,
completely.
all right. Well, I think we're all up to date with Penny and signatures, so.
Yes.
I hope so, yeah.
Yeah, more than a month.
Yeah.
So that should be,
We all settled.
there you go.
All right, thanks so much for.
Sure, thank you.
Yeah.
Good to see you again, Brennan.
That's what we do. That's where I work. I work in capitalism.
Capitalism.
What do you do?
I'm a executive in a software company.
Oh,
He does
AI.
technology.
AI.
Well, let's back up and mop up these little original items. Do we approve the minutes from last time?
Yep.
We can improve it as a last.
Would someone make a motion?
I make a
to that
motion, we
effect?
approve the minutes of our last meeting of
Seconded.
June. What was it?
Or,
Was it, or July,
It was July.
what's the date?
The last minutes. Hold on. I've got July 6th.
July 6th.
All right.
2026. I need a second.
Too many tabs open. Seconded.
All right, all in favor?
Aye.
Aye.
Aye. All right.
Aye, Captain.
No members of the public are present unless there's anyone on Zoom. No,
the stuff.
okay.
Boy, they would have dropped into sort of a weird on.
Yeah,
Hearing about capitalism.
Yeah.
Yeah.
Would have been tough for them to hold down for all that time.
Although that would have been really interesting if you had just popped in to listen to that nice little summary
you could
of the
learn, you
market.
could have learned
Yeah,
something about the market.
Absolutely.
Yep.
Get some tips on where to put your money for the future.
I just feel like I want them to have a list and then to watch for when one of those stocks gets punched in the face and then buy a ton. That's what I do. Buy a ton of that. Yeah.
So just to update you, I've been talking with Anna and working on the year-end reconciliation. And it was so easy, we balanced. There was nothing
Yay.
off.
Congratulations.
Yes.
oh, wow.
How did we do
That's not
that?
because we weren't spending any money or anything.
No, it's just because Anna
We're a
keeps a
good
very
team. That's the
clean
reason.
set of books.
Hey.
So, at this point, we think, unless some last little invoice comes in, we have last year, down to a final report. And based on that, we put together the numbers, we entered the numbers for next year's budget in the QuickBooks program, because we think that the rollovers from last year are now pretty much fixed, accurate. So, I'm gonna give you that just. And not the other ones right now, I think. I also have this for the beginning of 27. Wait a minute, I heard another one. You got it. All right. But I wanted to tell you that I did 3 transfers between lines that we had previously decided to do. Number 1 was to take, see about halfway down the front page, there's FA01, which is the Fine Arts Auction Sales. And we had decided to take 6,197.60 of that and move it up 2 lines to Fine Arts, where there's currently a negative remaining. So I did that on the books, which leaves 10,000 in the auction sales revenue for us to decide what to do with. And that 6,000 balances out, is balanced by the -54 and puts some money in the fine arts line. So that was 1. And number 2 was for about 3/4 of the way down the page, you get to SGO1 small gifts, which has gotten up to 7,600, and we had decided to take 4,000 of that and put it in BR15, which is board approved projects. So it's still all cash in the money market account, but I moved it from out of the small gifts line to the board approved projects line, which is just money that the board can spend whenever we vote to do so.
Does that bring the board approved projects up to
28,
20?
yes.
And we have nothing especially, I think some of that is for project manager for
Probably,
the project.
yes. The other piece of the project manager is, the third thing I did, will do, is to take 10,000 out of board projects. Board approved projects is BR15, but we also have a Schwab account called board projects, a separate one, and we decided to take 10,000 from that and put it in the buildings and grounds committee line, which is SPO1.
So is that BR20 project?
Yes. So 10,000 will be coming to add to that 1,908 that's there. And that's available for spending on the project manager, and by vote of the board, we can take anything we want out of board approved projects and, throw a party or we used to do that. We used to have a party for the staff once a year, and that was the line that
We
funded
do
it.
like,
A
yeah.
breakfast. We used to have a
Let's
breakfast.
do that again.
Yeah, let's,
Yes.
we did staff bonuses and stuff out of that.
And yes, and staff bonuses have also come out of the employee leave awards, because that hasn't really gotten spent on employee leave that much. But yeah, so all those things are available.
Cool.
Oh, and in board approved projects, which is our Schwab account, we've got 3 buckets of money. One of them is Sanderson Pike money, which has been there for some time, which is a bequest that we received in the past. And some of it is Nancy Browse money, and some of it is a very recent anonymous gift that we got that's about $4,000. And just going by date, I'm gonna take that 10,000 out of Sanderson Pike, because that's been sitting there a while, and we're supposed to use that money within roughly 5 years, or go ahead and put it in the endowment.
So
So,
are you gonna put it in the endowment, or are we gonna?
No.
No, we're gonna put it in.
we're gonna use it.
We're gonna put it in board
We're
approved
gonna-
projects and then you spend it.
We're gonna put it in the Buildings and Grounds
Oh,
Committee,
okay.
yeah, and spend it. Okay. The piece that I don't have done yet is the quarterly report, which is where we get the figures for the town report, which happens on the calendar year. But now that I have all these numbers, I'll be able to do that one. And we have completely reconciled, and as soon as we're really sure those rollover numbers are final and we have the budget, then Anna's ready to give the budget to the town, because they like to keep their own parallel set of books. Which is a good, it's good to have more eyes on the money.
Do they keep a budget of all of the things that are just ours, like all of this board money,
They do,
even though it doesn't have anything to do with them?
yeah.
They keep the endowment, all the BR coded ones.
Yeah,
Yeah, the beer, yeah, not all the, no,
They
And-
don't keep the,
they don't keep the Schwab account. Well, they do, Leela does keep track of all that. But the part that they need in their system really is the parts that we might spend out of our money market account, because say we have put money into the money market account, say we want to buy something, what really happens is the town writes a check for it and we reimburse the town.
yeah, that's what these checks we write every month are.
So the town needs to be able to say,
Here's
They're
this
gonna
line,
get
it's
their
coming
money
out of
back.
this line,
And
and
here's the
there's so
money.
much money in that line.
So they can see what we're doing, but they can't, I mean, they can't access the money unless we sign the check, so, you know, it's like, there's a check on, it's not like the town could take our money.
no, but all I'm just thinking
It's
of,
not like
oh,
we-
no, I don't know that I wanna say it into the owl, what I'm thinking.
Well, it's, yes, people can also, because we're a public entity, people can find out how much money we have in our endowment, well, it's publicly disclosed every year in the town report, so people can make a guess.
And as
Where-
far as I'm concerned, the more people have eyes on the account, the safer and better it is for every single person who has anything to do with the account.
Yeah, of course, no, that makes all the sense in the world, I'm just sort of thinking about at some point, they're gonna be like, wow, we should just cut the budget. of the
Well,
library 'cause
you know, it's a
people-
conversation that does, but it's also, it's a conversation that does happen.
I'm sure it
And-
does,
and,
when
you
you're
know,
pinching
and
pennies.
Like a big part of our job as advocates is to say, well, no, you know.
No.
No, you're not going to do that.
We need this money and this money
Yeah.
because
We are
we
spending
have
it.
to do all these things.
Right.
Yes.
And maintaining a, you know, a partnership for the betterment of everybody in the town, so.
Yeah. Okay, so that's where we are.
Yay.
Well done, you guys, glad I don't have your job.
The construction budget
I
thing,
know.
you haven't gotten anything new from, I mean, they seem to be doing things. Have you been?
That come
have you
out,
been-
where does the money for cleaning up the front of the building come out of, what they're doing? Which one of these?
It's.
That's grant money.
Yeah, that's grant. It's
Oh,
all the grant.
$7 million grant.
Okay.
Yeah. That was the first thing Prentice asked me, by the way. I haven't seen any drain on the account for all this work that's being done.
Hmm,
And it's like,
Where's it
yeah,
coming?
Good.
Yeah, Yeah, we're not.
And hopefully you won't.
I mean, it seems to be, I mean, the last time we spoke to the state, which was a couple of weeks ago, you know, we're kind of, there's been some shifts in that there's some work that needed to be redone or rescoped or anything, but we're not like super over budget, we're not under budget. And, you know, there's been some changes and stuff, but it's like, it seems like there's still enough money and there's a pretty healthy contingent, well, I don't know, there's a contingency that we may spend.
Mhm.
And they're gonna be done on time. That seems to be the big question, is whether or not they're gonna be
That's the
done.
thing that everybody seems to care about the most.
And that's why we started doing both.
Yeah.
The original plan was the back would be completely done and then we would close the front. We are behind schedule, so that's why we had to start and have this crazy.
I wondered about that, and because
So
when I
we're-
read the notice, I thought, well, we didn't discuss that.
Yeah, but
And
that
people
was,
can get into the library, so.
yeah.
And so
Yeah.
with the back, where are they at with that? Is that moving along or?
It is moving along. They still have, some concrete that has to go in.
That's the problem.
And that's been the real holdup with the weather.
Yeah.
The other day they poured their biggest slab and then we had that horrendous downpour and they were out there covering it with plastic and they had to redo stuff.
Bummer.
So that's a big thing. So I think they have 2 or 3 more sections that they have to pour that they have framed out. And then they have to install some temporary handrails The handrails we were originally gonna use, we were gonna use the ones that were back there. They were
Can't
too
use-
degraded.
Can't use. them.
So they're gonna have to manufacture some new ones, so they'll put up some temporary so we can use it. Hopefully within the next week,
Yeah.
that will happen.
And then, I mean, eventually that'll close back there for a little while because there's a canopy and stuff that's gonna go over there, so they're gonna have to put in the supports and install that, but that's also being.
And that was the thing that had to be re-engineered, right? We talked about
Yeah,
that.
there's
the
some
base
of
of
the supports
it,
on the
yeah.
command.
And with the canopy, they expect it would just be a 1-day closure
Oh, well, that's gonna.
to just install it over the door, so they can't have people going through the
Yeah,
door
right.
while they install it.
Well, that's good, it's only 1 day,
That is,
cause I thought, oh, that'll be a week, but no, maybe not.
no, 'cause
When do you think
it'll-
it'll get open? The back door?
the back should be within the next week, but
Really?
there'll still be work that needs to be done out there. So it won't be complete, but it'll be usable.
Do they still have library parking up there?
So right now, we don't have it here because we first moved it down along this way. And then some of it is actually over in the Harris lot, cause
Right,
it's actually
right.
easier to just walk over from the
From
Harris
the
lot.
Harris lot, so you don't have the parking up there like you used to?
We will, once this door opens, what the plan is, when this door opens, we're going to leave the Main Street entrance open for a few days. So both will be open because that'll give us enough time to notify everyone that we're going to be going just to the back.
Oh, okay.
And then all of the library parking will move back up to
Not
the,
on Harris Street anymore?
not on Harris or over here. It'll
So-
all go back.
We won't be able to use that parking anymore.
No, cause you'll be coming up here. I mean, this down here
Very convenient.
has always been undesignated.
Yeah, you
Oh.
can park there,
Oh.
I mean, I park there all the time.
Yeah.
Before this project, and I'm like, now there's signs that say you can park here, but I always.
But before you could always park.
Yeah.
Yeah, I never thought you could.
Yeah.
Neither did I.
Is
Um,
it free?
For a while it had meters, but it hasn't had meters for a long time, so and it's like it's municipal property and there's no sign, you park there.
Along the side?
Yeah,
Yeah.
so nobody cares.
Do we have any other business?
We do not.
Okay.
We have our next meeting set for Tuesday, September 1st,
Oh, we're
twenty
gonna-
26. Is everybody in agreement with that and knows about it? We're moving to Tuesdays, which we had decided on before, and put it in the minutes, Bob.
Yep.
Okay,
September 1st, right?
Acclamation, we move the date.
all right.
No, I like it.
I think we're done.
Thank you.